Hello folks, welcome back to the channel. Today, we dive into the deep end of global economic mismanagement and a widening financial chasm that's leaving investors confused, governments in damage control mode, and billions of citizens caught in the crossfire. It's a story of bulls and bears, where Wall Street is soaring to new heights while Europe stares down another inflationary crisis and China's policymakers scramble to shore up confidence amidst mounting pressure. What's going on here? I know many of you have been following these developments closely, and some might even feel the pinch from your own investments. So, why are we seeing such extreme disconnects between buoyant US asset markets and bleak economic prognosis in the rest of the world? Let's break it down. Let's kick things off with the United States, where Friday saw a particularly eye-popping surge, a shortened trading session that managed to close out the best month of 2024 so far for US stocks. How do we explain this ongoing euphoria in Wall Street, especially when the rest of the globe feels like it's standing at the edge of a sharp recessionary cliff? As per recent data, US unemployment rates remain historically low, hovering around 4.9%, a statistic that, typically, would signify a strong, resilient economic environment. But there's something artificial in the mix. Bank of America strategists have aptly described what they call an extreme disconnect between this seeming investor optimism about US assets and the pessimistic outlook for the global economy. Corporate earnings projections in the US are conspicuously bullish, with 2025 earnings growth forecasts penciled in at around 15% according to Columbia Threadneedle's William Davies. But here's the kicker, these projections hinge on low inflation, strong demand, and relatively benign interest rates, none of which are guaranteed in the current volatile global climate. This euphoria is largely driven by what some may call wishful thinking, akin to flying Icarus too close to the sun. Wall Street risks ignoring imminent dangers in the form of persistent geopolitical uncertainty, gradual interest rate hikes by the Federal Reserve, and volatile energy prices. As the Federal Reserve gently taps the brakes by gradually hiking interest rates, the focus on soft landing scenarios may be masking underlying weaknesses across key sectors of the economy. While investor sentiment is riding high now, it feels oddly divorced from the palpable global risks that could drag down the economy at any moment. But while Wall Street parties like it's invincible, Europe and Asia are singing quite a different tune. Let's talk about what these much quieter shades of red really mean for investors beyond the US borders. Over in Europe, there's little to celebrate. The euro area's inflation surged above the European Central Bank's (ECB) 2% target, with key indicators showing persistent inflationary pressures that have many consumers and businesses on edge. Quite honestly, the eurozone has been grappling with inflationary pressures since the onset of the Ukraine war, which wreaked havoc on global energy markets. In several ways, Europe has yet to overcome the cascading effects of exploding energy costs. Despite the ECB's somewhat aggressive interest rate hikes to contain inflation, the underlying structural drivers, like energy dependency and supply chain disruptions, are far from resolved. With inflation again surging past the 2.5% mark, Europe's economic stability is hanging by a thread. The dichotomy here couldn't be more evident. While the US is boasting of a bullish stock market and relatively low inflation, Europe is weighed down by runaway inflation that's pushing household spending power to the brink. And then there's China, where optimism has strangely re-entered the market, but not for the right reasons. Key stock indices like the CSI 300 are bouncing back, not because of actual economic performance, but rather from hopes that Beijing will pump in yet more stimulus to keep things afloat. Is this sustainable? Investors seem worried but also hopeful. The Central Economic Work Conference coming in December is already grabbing attention, with traders speculating on how Beijing might rescue the economy amidst escalating trade tensions and a sluggish post-COVID recovery. This recent bounce in the CSI 300, jumping over 2.3% on Friday, feels more like a market exhaling relief over the prospects of more free money, stimulus-driven growth projections rather than any substantive engine of systemic consumer demand or governmental reform. China's real economy remains plagued by multiple issues, staggering debt burdens in the property sector, significant youth unemployment, and an aging demographic that threatens to constrict future growth prospects. While China's leadership may go to great lengths to project an outward show of confidence and stability, the relentless need for monetary and fiscal stimulus is simply a signal that serious foundational problems remain unresolved. But here's the paradox, the People's Bank of China continues to prop up the economy with rate cuts even as the Chinese yuan weakens. More stimulus is essentially a band-aid, masking a deeper systemic malaise. And this bet on short-term infusions of liquidity may eventually backfire, as it has in many other middle-income economies. Meanwhile, Japan's currency is becoming a new battleground. Recent advances in the yen, rising more than 3% against the US dollar, suggest that investors believe the Bank of Japan may finally hike rates next month. Given Japan's long-standing reliance on near-zero interest rates to goose economic growth, a pivot seems to be on the horizon, marking a significant turning point for the world's third-largest economy. Here's the thing, Japan sits at a precarious juncture. It has become one of the largest buyers of U.S. debt, largely to counter the effects of the ultra-loose monetary policy it's long held on to domestically. Any hawkish shift from Bank of Japan Governor Kazuo Ueda could unleash a chain reaction across global bond markets, particularly in the U.S. The yen's recent rise against the dollar could be one of the clearest signals yet that markets recognize the risky, asymmetric policies that could unsettle the global financial system. And of course, we can't ignore the swirling political dramas in the United States as they continue to fuel economic uncertainty. Former U.S. President Donald Trump's inflammatory nomination of Tulsi Gabbard for America's top intelligence post has raised fresh alarms about whether core governmental competency is reaching new lows, endangering, it seems, not just domestic politics but also critical geopolitical relationships. Why does this matter? If Gabbard's nomination moves forward, and her well-documented pro-Russian leanings complicate international cooperation, we might see a pullback in foreign investment and intelligence sharing, directly harming U.S. national security and, more crucially, American economic interests abroad. So, what can we make of all of this? Folks, there are glaring, massive imbalances across the global economic system. The U.S. celebrates market highs that are, quite frankly, built on an increasingly shaky foundation. Europe is still fighting inflation, not just any inflation but a prolonged period of high energy costs and reduced household spending. China is printing money to buy time, erasing any natural growth that doesn't rely on increased debt. Meanwhile, Japan stands ready to flip the switch and potentially turn global market flows upside down. It's a mess, a disconnect of epic proportions. For investors and professionals out there, the takeaway couldn't be clearer. While we might enjoy the high times this year, we should brace ourselves for the avalanche when these tenuous disconnects unravel. Diversification, careful attention to geopolitics, and a recognition of these global imbalances are critical as we move into 2025 and beyond. I could go on for another hour about this, but the message stays simple: disconnect leads to disarray. Stay safe, stay informed, and don't buy into the hype without looking at what's lying beneath. Because trust me, it's a much darker world out there than those glowing US stock markets might lead you to believe. Stay tuned, we'll keep following these developments.